Imagine that the S&P 500 just dropped 10% in a week, and everyone on your feed is saying sell, sell, sell.
But while the world is panicking, we're actually doing the opposite.
Today we're going to show you exactly why a stock market crash might be the best thing that ever happened to you on your journey towards financial independence.
So grab a drink and let's talk about how to stay wealthy when the numbers go red. Hey guys, welcome back. If this scenario happened and you checked your brokerage account, you would probably feel like you've been punched straight in the gut.
Seriously, we talk about the path to FIRE, financial independence, retire early, and usually that path looks like a nice, smooth upward line.
But the reality of the stock market is that it's more like a mountain range. You've got peaks, but you also have these deep, terrifying valleys.
So let's say we're in that valley right now. And for a lot of you, this might be the first time that you've actually seen your net worth drop instead of continually rising.
So today we want to break down why this happens, why your FIRE goals aren't actually ruined, and the 3 specific moves you can make to take advantage of this chaos.
All right, guys, let's get real. How did you actually feel when you saw like $20,000 disappear in our index funds in the stock market crash of 2022 or during the COVID crash?
Yeah, so honestly, it stung a lot. I mean, there were times where I think we watched it and we were like, oh, that does not feel good when you see that number go to that much of a red number.
Yeah, and in our case, it was down even more than that, and it was pretty scary for the first time.
Yeah, but we're all human, so we have to remind ourselves that money didn't necessarily disappear because we didn't sell those shares.
So this is the paper loss concept. Think of it as your house. If the neighbor's house sells for less today, your house is technically worth less on paper, but did your kitchen disappear? Is your roof gone? Is anything really different about your house compared to your neighbor's house?
No, you actually still have the same asset. In the stock market, you still own the same number of shares in the 500 biggest companies in America. They're just on sale today.
And honestly, I have to admit that I think Amber and I both struggled with this. We used to refresh the Interactive Brokers app like every 10 minutes, 5 minutes.
Maybe less than that.
And
please don't.
I know, and it's like a great dopamine hit when everything is green, and then it's really a nightmare and anxiety sometimes when things are red, especially in a stock market crash situation.
Yeah, you can really see our emotions change when that happens and like how we react to things based on what we saw in the stock market.
By the day, by the hour.
Yeah, I know. So now we know some of you are like us. You're already in early retirement or you're very close to it. Telling you to just delete an app to not watch it feels a bit like telling a pilot to stop looking at the altimeter while the plane is dipping. You need to monitor the situation, but you need to do it without the emotional tailspin.
Exactly. And when you're living off your portfolio, a crash isn't just a paper loss, it's an actual threat to your withdrawal strategy, so you have to pay attention. Instead of just doing a digital detox, your first actionable step is looking at that 2-year cash buffer audit.
So open your accounts and look specifically at your bucket 1. This is your liquid cash and your short-term equivalents. Do you have 18 to 24 months of living expenses sitting there? If the answer is yes, then today's, or in this case in 2022, that 10% or 20% drop in the stock market doesn't actually affect your lifestyle for at least 2 years.
And this is how you keep your investment brain separate from your spending brain. By confirming that you have that cash runway, you can give your stocks the time that they need to recover, and instead of being forced to sell them when they're down and taking a loss in order to pay your electric bill or whatever, you pay for your groceries that month. And really, this is the real secret to being retired and surviving during a crash.
So if you look at your accounts and realize your cash bucket is low, don't panic. That's when we move to step 2 that we're going to talk about, looking at the technical indicators to see if we should trim some of our safe assets or pivot our spending rather than panic selling for growth.
Okay, so we've received a lot of comments in our previous videos, and one of the things that we've seen and even seen it on other YouTube videos is that the 4% rule is dead. And I guess what they're thinking is that if the market drops 20%, they'll never be able to retire.
Actually, the math behind financial independence, specifically the Trinity Study, includes years like this. It factored in the Great Depression, the 70s inflation, and the 2008 crash.
And this is where you need to look at your 25 times your annual expenses to be free. That number assumes the market will have these bad years.
If the market only went up, you'd only need 10 times your expenses. The buffer is there for exactly what's happening in those crash moments.
So let's look at this sale mentality a little bit closer. If your favorite steak goes from $20 to $14, you buy two. Why do you do the opposite for stocks?
It's the fear of catching a falling knife. People think that, what if it goes to zero?
But as I often say to Amber, if the S&P 500 goes to zero, then we've got a lot bigger problems than our retirement accounts and our income for the month. So in reality, we'll probably be changing like cans of beans or food or our most precious possessions for ammo for guns and who knows. But honestly, since that's pretty unlikely and hasn't happened so far in our world, buying now is just buying future wealth at a discount. Okay, so let's get into the weeds a little bit on this. So we're not day traders, but we do use institutional guardrails to know when the blood in the streets is actually reaching a turning point. We look at the monthly charts, so the longest term, no daily, no hourly.
We focus on two main indicators to spot generational buying opportunities, the monthly RSI and the monthly MACD.
The RSI oversold floor, let's talk about that. The relative strength index, the RSI, measures momentum. On a monthly scale, if the RSI drops below 30, it means the market is historically exhausted. In the last 20 years, every time the S&P 500 monthly RSI touched 30 to 35, it was a table-pounding buy signal for long-term investors. I just can't believe that, over the last 20 years, every single time consistently. That's a
pretty
amazing.
big indicator.
Yeah, you should definitely pay attention.
So it's like a rubber band. The further the market stretches it down, the harder it eventually snaps back. We use this to decide when to move our extra cash into the market. For an early retiree, seeing that RSI hit the floor is your signal that the sale is reaching its peak, and it might be time to stop worrying about your withdrawal rate and start looking for long-term recovery.
So we talked about the RSI, now let's talk about the MACD, and specifically the monthly MACD bullish crossover. So since we're monitoring the markets relatively closely, I'd say once a week, trying to keep an eye on things, we're not just looking for hope, we're looking for high probability reversal zones. For us, the monthly MACD is our trend guardrail. If we see a bearish crossover on the monthly chart specifically, that's our signal to tighten up discretionary spending as much as we can. And just so you guys know, MACD stands for Moving Average Convergence Divergence. We look for the monthly MACD histogram to start ticking upwards, even while the news is still bad.
When that blue MACD line crosses above the signal line on a monthly chart, it's often the all-clear signal that the long-term trend has shifted back to bullish. This is how we avoid catching a falling knife too early. So after we have the RSI and the MACD, there's move number 2. We have to check your emergency fund. If you have 6 to 12 months of cash sitting in a high-yield savings account, a market crash is just noise to you.
Okay, now if you don't have that cash and you're forced to sell your stocks at the bottom to pay rent, that's how you lose the FI game.
Move number 3, rebalancing. If your portfolio was 80% stocks and 20% bonds and the stocks dropped, you might be at 70 and 30 now.
So selling some of those bonds to buy more of the cheap stocks to get back to 80-20 is a mathematical way to buy low without using emotion. Okay, so in addition to all those technical indicators, so the RSI and the MACD, and then having this emergency fund, there's another indicator that we kind of laugh about, and that's when a lot of people that we know that don't really pay that close attention to the stock market, when they start calling me up or texting me and saying, hey, should I buy this stock? And then 99% of the time I look at that stock and it's at like all-time highs and it's been on a tear for a long time. And I usually do some due diligence, or I say, dollar cost average it. But in general, I'll say, don't buy it right now. Don't buy it at the peak when everything seems to be going well and there's a lot of hype and people are pushing that stock. I think typically that's the worst time to buy.
The phrase is buy low and sell high. But what's crazy is that in reality, most people tend to do the opposite.
And that usually is a signal for me to say that, hey, we might be reaching a top in the market and I should start looking at some of these technical indicators. And then, you know, when the opposite happens and the stock market is crashing, I don't get those phone calls.
It's like silent.
Nobody's definitely asking, like, should we buy now? They're all just freaking out saying, oh, this is the time that I'm going to invest less. I'm going to cut back on my contributions to 401k, things like that. And then, you know, if that ever comes up, I just say, you know, that's actually the worst thing. That's the opposite thing you should do. You should be investing at that point. So it's just amazing that people still just think the opposite way with this. So that's like another little secret indicator that we have is when we start getting those questions from people that, you know, aren't necessarily paying attention.
And then that's where that dip comes in, where you want to kind of like strategically not put it all in at one time, but kind of buy in as you see that progress.
And one of the things that we've done for several years is we'll buy in stages, or maybe we'll have like 2 or 3 stages. Right now we do like 4, so we're not just buying at one particular time.
So let's take a look at 2008 on this chart. It looks like a huge cliff, right?
Yeah, and I mean, I was just kind of getting into the investing game back then. You know, I only had a job for a couple years, but I do remember it being really scary, especially for my parents, and people were freaking out, and it looked like the end of the world back then, that's for sure.
Now, look at where we are today. That cliff looks like a tiny little speed bump in the road.
Yeah, that's pretty amazing in retrospect how these things look. And even think about COVID, how much of a little blip that looks like. I think it was a bear market for like 3 months.
Yeah.
And then that thing was over with. If you look at it now, it just screams like an opportunity to buy or an opportunity to just not even pay attention to what was going on in the
It's
stock
a small
market.
little blip.
So the path to financial independence isn't about being a genius trader. It's about being the last person standing.
It's about endurance. Wealth is transferred from the impatient to the patient during times like this.
Okay, so let's look at an example. If you're 30 years old now and you want to retire at 45, you actually want crashes now. You want to accumulate shares when they're cheap, not when they're expensive, so that when the recovery happens, and so far it always has eventually, your snowball is going to be massive. And if the technicals look scary, move to your defensive strategy. This is where Barista Fire and Coast Fire come in, and they're really handy. So if your portfolio takes a hit and you can earn $1,000 a month doing something you enjoy, if that answer is yes and you have something like that lined up, the market crash loses its power over you.
Yeah, so also check your asset allocation. If you realized during this time that you can't handle a 20% drop, you might be over leveraged in some of those stocks. Use the next recovery, not right now or not when that crash is happening, but during the recovery to rebalance into some safer, boring assets like treasury bonds or a higher cash cushion.
You can also look at, if you are invested in individual stocks, look at stocks with a lower beta, so they're less volatile during that time. That's something that Amber and I have learned the hard way over the years, is that like those Tesla is actually a decent example. I think it's like 2.5 times as volatile as the stock market. So stocks like that, when they're doing well, they seem great, but then during crashes, they just go incredibly hard with the crash. So those are some things to look at as well.
Let's recap. Number 1, don't panic. It's a paper loss, not a real one. Number 2, trust the math. Your FI number already accounts for volatility. And number 3, keep buying. Use this sale to your advantage.
And you know, a stock market crash is actually just a giant transfer of wealth from people who are reacting to the news and looking at all that stuff on social media, and the people that are actually looking at the math. And we know that it's scary. We've been through 2 big crashes, the COVID crash in 2022. So, you know, we felt it too. We've been through it, but we're staying the course, and we want to make sure that you guys stay the course with us.
So during this time, stay disciplined. Watch those monthly indicators for the all clear. And remember, the goal is freedom, and freedom is bought when prices are low. So if this video helped calm your nerves, hit the like button so more people see this, and don't make the mistake of selling at the bottom.
And tell us this too. What are you guys doing with your portfolio right now? Are you buying more, or are you just holding tight? Let us know in the comments. And what do you think is coming? Do you think a crash is coming in 2026? Do you think we're going to all-time highs? Let us know what your predictions are and then how you plan to handle that.
So we'll see you in the next one, guys.
Bye, guys.
Bye.
Thanks.